Joining us tonight with reaction to this market performance, the Wall Street attitude toward both the president, his trade policies, and these tariffs, as well as China's, retaliation. Chief economist at the Milken Institute, Bill Lee, joins us. Bill, good to see you. And John Lonski, chief economist, managing director at Moody's. John, let's first start with a $60 billion of retaliation and 600-point sell-off in the market. Now, I'm not being cynical here, but I am also not ignoring, some 30 years of experience. It looks to me like Wall Street has been encouraging precisely the result they got today.
Yeah, perhaps they have, but I think the sell-off, much of their surprise and displeasure has really gotten carried away. You're talking about $60 billion of goods subject to tariffs, and the sell-off since this began Friday, May 3rd, is between $1.4 and $1.5 trillion. You got to be kidding me. This is all out of whack.
Bill, what do you think? I mean, John's making a great point here. $60 billion in retaliatory tariffs, and Wall Street goes nuts.
A lot of the volatility, of course, is amplified by machines. So we have machines amplifying the panic that's in some of the Wall Street traders. But let's face it, the Wall Street traders are also smart enough to see that there are a lot of opportunities there that are being created by these low values. Google and a lot of domestic producers, healthcare, these are sectors that are going to do very well to investors that are smart enough to buy them at these low prices.
Bill, you haven't changed a bit over the years. You find opportunity in every direction, and that's one of the reasons we like you so much. But this is, they can pull the plugs on those machines, and I often think they're nothing more than, an apology, a rationalization, John, for what Wall Street wants to do. This is deplorable. What these as Peter Navarro put it, these unregistered agents on Wall Street behaving as they do, taking the China point of view against the president and his efforts to balance trade, to create reciprocal relationships, and to bring back what have we got that full screen to show what this has cost the United States in economic growth over the past 20 years, these deficits with China. Do we have that? I'm waiting for, we're getting it, I'm told. While we're waiting to get that, well, there it is. This is the U.S.-China trade deficit, which is $83 billion back in 2001. It's risen to $419 billion, 500% increase. And over that time, it's $4.5 trillion stripped out of the U.S. economic growth. And we have these paid consultants for corporate America and Wall Street firms saying, it's a zero-sum game. It's no problem. Well, if it weren't for President Trump, and you don't have to comment on this, but feel free to do so. If it weren't for President Trump, this nonsense would still be rolling.
But eventually it would come to the forefront. This would become a major political issue. This could lead to, who knows, down the road, a further radicalization of some of these people of the working class that are very upset about the situation. It's a good thing that Trump shed some light on this type of imbalance. So let's not forget the fact that somebody's being hurt by this $4.5 trillion cumulative trade deficit with China over the past 20 years. I'm not getting hurt. You're not getting hurt. It would be the people from the manufacturing sector that were harmed, perhaps people from agriculture and so on.
Lou, let me add one more thing.
Sure.
I am so sick and tired of people saying that it's the American consumer that's paying for these tariffs. But the first thing you learn in international economics is it's the importers of the goods that are paying the tariffs. And the importers are both American and U.S. firms, American and Chinese firms. But more importantly, the importers are going to do their darndest to push the prices back to the Chinese, not the American consumer.
Yeah, this is such an important point. If you will break that down one more time, begin at the beginning for our viewers, because we are watching some of the business press in this country, the political press, the left-wing media. I mean, they are spewing such nonsense about tariffs that I think what you're saying needs to be underlined.
Well, it's the importer of the Chinese goods that has to pay the tariffs.
Right.
So the importer, the first thing he's going to try to do is to say, where can I find the same stuff at a cheaper price somewhere else? So they're going to go to different sources, different countries. And if they can't do that, he knows that he can't raise the price on the American consumer because the American consumer would just switch to another good. So he's going to try to push the price increase, the tariff increase, back onto the Chinese producer. And I think that's what President Trump means, that the Chinese are paying the bill. It's the Chinese importer and it's the Chinese manufacturer. Now, ultimately, if there is some price increase that comes in, the American consumer is not stupid. He's going to say, I want something cheaper. And so he's going to look for something cheaper. So the competitive forces are going to force a lot of the incidence of the tariff back onto China. Yes.
And let's not forget, ever since we've had this trade crisis with China, it began about a year ago, June of 2018, we still have pretty substantial consumer electronics price deflation. I mean, my goodness, core PCE price index went down from 2% annually to 1.6%. So tariffs really did nothing visible in terms of adding to price inflation. If anything, inflation went down.
But John, the one important thing that tariffs did was to change the supply chain. And what President Trump is trying to do strategically is use bilateral tariffs to change bilateral supply chains in favor of the U.S. That's the strategy. It's not this nonsense about reducing multilateral deficits. It's shifting the burden onto our friends and putting the price on China.
Let me play the role of mediator here because you're both right and on this issue. And the president is driving us toward balanced trade, which is absolutely essential to the health of the world economy, but most especially, of course, America. And we're seeing alternatives now as a result of these tariffs. And as Bill is pointing out, we're looking at supply chains for U.S. companies moving from China. They're moving principally to Southeast Asia, but also coming back to the United States. That process that's begun is already harrowing and unnerving China. And China's economy is much more fragile, while ours is far stronger than the president. I don't think is too far wrong when he says it's the greatest economy ever. We're looking at 3.6% unemployment in this country, 3.2% growth. My gosh! And look at the jobs that are being created.
You're right. And right now, what is it? We have more than 1 million more job openings and the number of people unemployed. I think that unemployment rate, by the way, is going to keep on going lower.
Advice to investors who may have been unnerved by this little Wall Street-inspired sell-off today. Bill?
Lou, one other thing about China. The tariffs are doing something very positive in China. It's reducing the power of state-owned enterprises and promoting the private sector and their domestic economy. That is what that is what Liu here wants to have the Trump do, is to give Xi Jinping a powerhouse of forces to go against the old guard there. And that's what we're trying to do.
Bill, appreciate the perspective. Very quickly.
I say hold, don't sell, don't panic. This storm will pass quickly enough.
And you know what? As soon as Wall Street firms understand what country they're in and whose interests they should be pursuing, that is of the nation and this president, the sooner we'll see exactly that. Reason and value prevail.